don't overcomplicate things. A lot of these principals like it very simple. They want to be able to go 1, 2, 3. Okay, good deal, bad deal. I want you to counter. Hey, beautiful people. Welcome back to Invested. Another question. Commercial lease analysis. How do you all calculate annual return? This person put y'all, so I'm thinking maybe Texan. So some backstory. I started with a smaller family office about a year ago and finally got the green light to revise and streamline their lease analysis spreadsheet. The current one they use is about 30 years old, and that was made by a guy before me who just retired. It's complicated. 9 sheets, cross-reference links, effed up formulas, terrible formatting, everything you hate about poorly made spreadsheet. Our entry-level analyst gets tripped up every time he plugs in new LOI. LOI is letter of intent. That's how they negotiate leases. What makes it worse is that the principal likes to review it, print it out. Enough backstory. The new spreadsheet is clean, but I'm struggling with how they calculate their returns. It was more complicated than this, but summarize their historically calculation, the return for potential lease as follows. He gives us how they calculated it. I'm not going to bore you with it, so I'll kind of summarize how it gets done. It's a great question. I mean, I have built many of these lease valuation, and they're unique to each company because if you're working for a private equity firm, you're going to have a complex one. It doesn't really matter. Everyone understands the formula, indexing, addressing, vectors, X lookups, H look. It doesn't really matter. So everyone knows the financial terminology. But you as an employee or a professional should be catering to your client's needs. That could be your principal who owns a property and he likes everything printed. I used to work for someone like that. I had to print. So then you got to figure out what is that principal looking to get out of that lease valuation to make a quick decision. So I can't tell you about your principal, but I can discuss with some of the principals or chairmen I have worked in the past what they wanted to see. So as you know, lease valuation template, however you make it in Excel or Argus, whatever it may be, it's going to have simple things, right? Square footage, the suite, the building, the rate, escalation. Is it 3% escalation? Is it 50 cents a square foot escalation annually? And you're going to calculate that. You're going to have a gross. Then you're going to calculate if there's going to be a TIA, tenant improvement allowance, and there's going to be landlord costs, tenant costs. Are you giving them $50 a square foot, $10 a square foot? Are you giving them $5 a square foot for paint and carpet? So that gets factored in because that's going to get into your real dollars on how much money you're going to put in your pocket. And also commissions, right? There's going to be leasing commission. If it's a brand new lease, you might have internal leasing commission, you pay 2%, and maybe outside commission for 4% for co-op brokers. So that gets all factored in to get something called a net effective rate. Because now if your rate's $2.50 per month, after you take out all that, what is your net effective rate over the 3 years or 5 years or 10 years? Is it going to be $2.50? It might be higher, it might be a little bit lower, depending on how much concessions you're giving. So some of the principals want to be able to make the decision fairly quick. So there was net effective rent, which calculates the sum product of all the accumulated rents per month or annually, minus is my upfront cost of leasing costs, tenant improvement costs. So then they want to see that. The second thing is my total profits. How much am I going to be making in this deal? Am I going to be making $150,000 over the course of 5 years or making $500,000? And what is my lease to cost value, right? For if I'm putting in $100,000 of tenant improvements or concessions, what is the cost of return on that? Usually it's 8%, 7.5%. That's where cap rate comes into play as well too, but that's a little bit more complicated. But usually family office, they want to know 3 things. How much money I'm making over the course of the lease, how much I'm spending, what is my net effective rent? If I'm starting at $2.50, over the course of 5 years, am I getting $2.50? Am I getting $2.75 because there's escalation? Or am I getting $1.50, right? That's going to be simple for them to understand because it doesn't matter if they know how to model or not. If they're a principal owning 40 buildings, they did something right. So they know how to make deals. So those are the 2 things. And the majority of the decision maker wants to know, what's my payback on my money? So we call it break even. Do I break even when the tenants pay me rent? Is it 12 months? Is it 6 months? Is it 36 months? Because what they want to know is if I'm doing a 60-month term, which is 5 years, I don't break even until month 48. Would I want to do the deal? I don't think they're going to do that deal. Because in that 4 years or 48 months, the tenant might go bankrupt. The tenant might default. So why would I put in that money? So usually it's been those three things that it's been very keen on it. It seems like you have analysts and you're pretty smart analyst or associate or you're advising the client. And I'm pretty sure you're good in Excel, so you can put in those Excel calculations to come up with those three things or four things, right? We call it key metrics. What does your principal want to see to make a quick decision or what they want to counter back at? Because they're going to say, well, that 250, if I give them $10 a square foot TI, I want to counter back at $3 and I'll settle at $275. And instead of wanting 5 months, I will give them 3 months outside the term. So instead of a 60-month term, I want a 63-month term because I want the full 5 years of revenue. So these are some of the things that you have to cater to your clients, your principals, your chairman, or the company that you work for. So there's no right answer how to calculate it, but I think you touch upon OPEX, triple net over the term, growth. These are all great information. So, I mean, long as you have all that, it's fine. And it seems like you do current shell costs. I mean, shell cost is your construction cost. I mean, I wouldn't use shell costs. I mean, maybe you do in Texas. So we'll kind of look at, hey, how much are we going to pay for the construction and what is the cost of return on that shell cost, right? So that's another sheet. Maybe that's something that the principal is really keen on. Maybe the principal has a development background and started as construction management or constructing buildings, and that's important to that individual. Then you got to put it in. And I mean, it makes sense because that actually will pull into your net effective. So I think it's the same thing. Yeah, I mean, all the stuff that you put in makes sense. Current shell costs, land basis plus building plus existing TIs, financing costs equals shell costs. That's more for construction. Annual return, net effective revenue divided by the current shell cost. You're trying to get your return on your money based on the building purchase and everything. So that's a little bit more complicated than some of the family office. So I had to assume your principal probably has some construction background or development background. So overall, you're on the right direction. Don't overcomplicate things. A lot of these principals like it very simple. They want to be able to go 1, 2, 3. Okay, good deal, bad deal, I want you to counter. That's all they want to do. They're extremely busy. They don't want to sit there and look at elaborate Excel spreadsheet. They're not an analyst. They're decision makers. So my advice to you with this as well is to cater to your client and your chairman, and you'll be very successful at the family office. Become an advisor. If you found this content helpful, please share, like, and add comments. Thank you very much.